Nicholas Ferris, Investment Director, Global Asset Allocation with East Spring Investments, joins us from Singapore. Nicholas, good morning. Thank you for joining us. How do you see global equities panning out as markets prepare for the imminent tapering?
Well, I don't think that tapering is necessarily imminent. I mean, my view is that it's most likely to occur or start to occur in September. So we think that that's probably the most likely date. But certainly the news flow on Friday night probably made that a little bit more of a marginal call at the moment. But generally speaking, the other macro news flow in the US, in particular the ISM survey last Thursday night and the service sector ISM last night, probably suggests that the US economy is starting to accelerate and that you will see robust hiring enough in order to justify tapering probably at that September meeting.
So looking at your views on the Fed tapering, what does this mean for fund flows in Asian equities?
Well, I think there's already been a pretty significant episode in terms of Asian rates, fund flows and flows out of emerging markets. I think if you look at the emerging markets, it's been a little bit bifurcated in the sense that the China-related proxies have been hit a lot harder. So the markets like Brazil, South Africa, Australia to some extent on the mining side have been hit a little bit harder than say some of the more domestic demand orientated economies. But we would also suggest that the domestic demand orientated economies, particularly in the ASEAN region, are reasonably expensive and from that perspective a little bit more vulnerable given their valuations.
Nicholas, so can we see a reversal in flows in the near term?
Well, I think we've seen some of it already, and you can see the pressure on the currencies, in particular the IDR, for example, or India in particular. The INR has certainly been under pressure. So I think that episode is already underway. And, you know, all we've seen, or all we've had so far is talk of withdrawal of quantitative easing. We haven't even seen a rise in the cost of capital. So imagine what happens when the cost of capital actually rises in a more material fashion.
Nicholas, you are bullish on cyclical stocks. Is this purely a call on defensives looking richly valued, or you expect growth to pick up in the second half, which obviously will make cyclicals look more attractive?
Well, I think you have seen growth improve in the US in particular, but also in Europe. So where we're most bullish on cyclical stocks is really in that part of the world. Particularly in Europe, I should say. In the US, the stock market itself is reasonably fully valued, particularly small capitalisation stocks. But if you look at the cyclical sectors within that market, there's certainly more value there. Whereas stable domestic demand stocks, and particularly stocks that have stable cash flows and dividends, have been very, very expensive. So if you look at world consumer staples or world consumer services stocks, they're trading at around 3 times book value, which is pretty rich relative to history.
So, Nicholas, I mean, what do you make of central banks anchoring short rates and suppressing the long end of the yield curve? Because the Indian Central Bank as well has reported tightening to provide stability to the rupee. Can these change the game for equities?
Well, I don't think they necessarily changed the game. I think they've helped over the last few years encourage investors out of safe assets into riskier assets, and that's part of the reason why the central banks are doing it. In my personal opinion, it does actually create some distortions and misallocation of capital, and it can create risks as well. So it's not necessarily all a one-way trade.
Right, so for rest of 2013, are odds in favour of Asian equities or Western markets like US and Europe?
I think that depends on the Asian equities you're talking about. I think if you're looking at the more cyclical markets, you could see considerable upside if the global cycle starts to recover. So, for example, Korea is a market we like from a cyclical perspective. But developed markets, I think, particularly those in Europe, and two of our key positions are Spain and Italy, are ones where you could see more upside given where valuation, sentiment and positioning are today.
So what's your outlook on the US markets for the rest of the year, and do you think investors will continue to favor this market despite expensive valuations?
Well, I think the US market is around fair value, so at roughly 14.7 times forward earnings, it's about fair value relative to history. Mind you, in 2007 it topped out at just above 15 times forward earnings. Parts of the US market are expensive though, and for example, the stable domestic demand type stocks or higher dividend yield stocks within that market. Small capitalisation stocks as well are trading at around 21.7 times forward earnings. So parts of the US market are expensive. I also think that expectations are already quite bullish on the US as well. So from a positioning and sentiment point of view, the US is a little bit vulnerable from there. If you think about US profit margins, the net profit margin in the US currently is around 9%. The historic peak margin in the post-war history is around 9.5%. Analysts have that profit margin going up to 9.75% looking forward. So that's probably a little bit too optimistic in my view. So there is scope for disappointment, particularly as we move into September, October.
And Nicholas, finally, your firm has a decent exposure to Indian equities as well. Your corpus is about $1 billion plus. You own stocks like HDFC, Mahindra Financials. What is your take on Indian equities going forward?
I think India is getting cheaper relative to its own history. So if you look at the valuation of the broad index, it's trading around average, whether it's a PE or price to book type valuation. But I think within the markets, similar to other markets in the region and around the world, cyclical stocks are trading at more depressed valuations. I do worry that the reaction of the currency to the central bank's actions a week or so ago is actually quite bearish, in the sense that you've seen, in spite of the central bank's actions, the currencies continue to sell off against the US dollar, or the dollar strengthen against the INR.
Good chatting with you then, Nicholas. Appreciate you taking the time out and joining us on the show.